Welcome to the Liquidity Detective. This video is for educational purposes only and does not constitute financial advice. Past performance is not indicative of future results. All trades shown are real, but your results may differ. Most traders think the hardest part of trading is finding the right entry. I think the harder part comes after you've entered. Can you still follow your plan when the market does something you didn't expect? That's where a strategy can either work as designed or completely fall apart. Mindset isn't a separate part of my strategy. It's what allows the rest of it to function. My framework is built around 4 connected pillars, but all of them depend on the same thing: making important decisions before the market forces you to make them. The mindset is simple: right mind, right plan, right execution. And the goal isn't to catch every move. The goal is to compound capital. There are 5 principles I use to keep myself focused on that objective. The first principle: be happy with planned profits. I don't need the whole move. Before I enter, I already know what I'm trying to achieve. If my target is hit, I take the planned profit. That's the trade. Sometimes price keeps going after I sell, and it's tempting to think I sold too early. But that's looking at it backwards. If I followed my plan, the trade didn't fail because price kept going. I simply didn't own the rest of the move. A good trade isn't measured by what I could have made. It's measured by whether I executed the plan. The second principle: trust the plan. Every trade should have a plan before money is invested: the entry, the ladder, the targets, the max risk, and how much capital I'm prepared to allocate. Those decisions are much easier with no pressure. Once I'm in the trade, price can move quickly or against me, and that's exactly when people start changing their decisions, moving the target, adding money without following the predefined ladder. The whole point of planning beforehand is to avoid making those decisions in the middle of the chaos. A plan written in calm should be followed in chaos. The third principle is probably the most important: accept uncertainty. I never know which direction price will ultimately expand. The market decides that. I can analyze value, liquidity, absorption, and where ownership appears to be transferring, but none of that gives me certainty about the next major move. And I don't need certainty. My job is to be prepared for either outcome. That's why uncertainty isn't a flaw in the strategy. It's part of the environment the strategy is designed to operate in. The real risk isn't uncertainty, it's being unprepared for it. The fourth principle changes the question I ask while I'm in a trade. Instead of asking, is the stock going up or down, I try to think like capital. Is ownership still transferring? Is my capital being used efficiently? Do I have enough capital to keep buying if the plan requires it? Is another opportunity better? Capital is the scarce resource. Price is only one part of the risk. So when I think about risk, I'm thinking about 4 things. First, capital risk: do I have enough capital to keep following the plan? Second, time risk: how long is my capital tied up? Third, return risk: am I being paid enough for that capital and that time? And fourth, opportunity risk: even if this trade works, could that capital earn more somewhere else? Risk isn't just price. Risk is capital, time, and opportunity. The fifth principle: compound, don't chase. I'm not trying to maximize one trade, I'm trying to build a process I can repeat. Take a planned profit, free the capital, find the next favorable situation, deploy it again. I don't need every trade to be exceptional. I need the process to remain repeatable. Small advantages, controlled risk, and consistent execution become far more meaningful when they're repeated over many trades and many years. The objective isn't one perfect trade, it's what happens when good decisions compound. But knowing these principles isn't enough. The real test comes when a trade isn't behaving the way you hoped. There are 2 ways to respond to that moment, and only one of them is actually following the strategy. With losing trades, the wrong mindset is: hope it comes back, move the stops, average randomly, close too late, and small losses become big losses. Winning trades have the opposite problem: hope for more, get greedy, give back profits, and a good trade turns into break-even or a loss. Neither behavior is really responding to the strategy, it's responding to the emotion of the moment. The alternative is the pro mindset. With a losing trade, I don't automatically assume I should buy more, I follow the predefined strategy. If conditions call for a ladder, I use it, manage the capital, and let the plan play out. With a winning trade, I take the planned profit. I don't need the whole move. I free the capital, and it becomes available for the next opportunity. It's about not allowing the emotion of the current candle to rewrite decisions that were made beforehand. And that's really what mindset means in my strategy. It isn't about pretending losses don't matter, or being confident the market will go my way. It's about making decisions that still make sense when the future is uncertain. I can't control the market. I can't control which direction price expands, but I can control how I deploy my capital, the plan I make before entering, whether I follow that plan, and when I take my profits. I don't need to catch every move. I need to compound capital. Right mind, right plan, right execution. This is the mindset behind every trade I share on this channel. The next step is seeing what it looks like when real money is involved. If you want to see this framework applied to actual trades, subscribe, and I'll see you in the next breakdown.